This is an important bond and fixed income update. First, the problem. Bond returns last year in 2022 were some of the worst returns in the last 40 years. I want you to look at the chart on the screen. Go down the first column, the third one. Long-term U.S. Treasuries, U.S. Treasury bonds were down 29%. 100,000 became 71,000. $1 million of bonds became $771,000. And even long-term investment grade bonds were down 27%. Wow. 2022 was the worst year. Some say on record it goes back to 1979, 1980. And this is due to the Federal Reserve Board's aggressive increase in interest rates over the last year. We went from a quarter of a point to 5.5%, a 20-fold increase in 1 year. Wow. And this is what's happened. As a result, I'll go over to the far right, the circle area. The two down years were the last 2 years in the fixed income market. And if you look at that chart, it goes back to 1976. What have we had? One, not counting last two. 1, 2, 3. 3 in the last 25, 30, 45 years. Yet we had 2 down years last year. This year, we're starting to turn around, and we're going to talk about that right now. For decades, bond and income investments have been the go-to for many people who are seeking consistency and reliable income. They provide regular income and security, and it's been a favorite. But now, I want you to look at this chart closely. Over to the far left, you can see that big mountain range. That was President Carter and Fed Chairman Paul Volcker. That was the last time we had record high inflation and record high interest rates. You had a 21.5% prime. You had 15% money markets funds. Treasuries got to 14 and 7/8. Tax-free bonds got to 12%. But if you look through then, you've essentially had a line almost straight down to the current rates of last couple of years. There's a couple of bumps on the rate, but we've gone from 21.5% prime, 15% money markets, down for the last 25, what is that? The last 40 years. For the last 40 years, no income investors have seen a bear market. Their values have always gone up because rates have declined. And then look at the end of it. Here's where we are now for the last decade, except for that one bump. We had zero. We had a quarter of a point in the bank deposit programs and the money market funds. And then in the last year, they went up from a quarter of a point to 5.5%. That's a 20-fold increase in 1 year. And now we're 5.5%. And here is the key. 2 key questions. 1, have rate increases peaked? We think the answer is yes. And 2, how do you take advantage? That's what we're going to talk about next. These are the things that are affected by the rise in rates. Corporate bonds, dividend stocks, mortgage-backed bonds, municipal bonds, real estate investment trusts, and treasuries. I've got many people who had 5.5% tax-free bonds. Then they got called, and then they had to reinvest at 3.5%. And they would say, I can't live with a big cut like that in my income. We're at one of those pivotal points right now. Here is the key to understand this. When interest rates rise, income investments decline. It's exactly as that seesaw illustrates. Look at the left. When rates go up, the other seat, fixed income investments, go down. That's what you saw last year. And where are we right now? As we film this, the end of December 2023, inflation was a priority for the Federal Reserve Board, who raised rates rapidly to slow down the economy and inflation. In June of last year, inflation peaked at 9%, and the Fed's strategy is to get it back to the 2.5% rate. Now, look at this next chart. Last year, 9%. This chart is the beginning of December. The CPI was at 4.8. That cut inflation in half from 9 to 4.8. We're actually now 3.5 to 4. That has been the largest drop in inflation since, again, the Paul Volcker era of 79, 80, 81. Okay, I'm going to read a quote from Chairman Powell. This is the Wall Street Journal, December 10th. First paragraph. The big questions now are about when the Fed can start cutting rates and by how much. Let me repeat that. The big questions now are about when the Fed can start cutting rates and by how much. The answers will matter greatly to households, markets, and possibly the 2024 presidential election. Next paragraph. One danger is that Powell and his colleagues, blamed for reacting too slowly to address surging inflation 2 years ago, will wait too long to lower rates as they ensure inflation is fully extinguished. This mistake could curb economic growth too much, causing a recession. So, it works when rates go up, bond prices go down. Well, it also works on the other side, on this other seesaw. When rates go down, income investments historically appreciate. If you're able to get somewhere near the top, not only do you get a more attractive yield, but you see your values should appreciate over time as well. Okay, look at how quickly and how much rates can drop. That first down bar, the top line across the point, is at 0%. The last time the Fed peaked at rates with the last rate, rates in 1984 dropped 3%. They dropped 3% from the peak. The next one just about 1%. The next one dropped over 2%. And again, if you think of having someone with a 5% muni bond and rates go down to 3%, it affects your standard of living. Now, a question I get an awful lot these days is, what about money market funds? I'm getting in many cases over 5% in my money market fund. And if you can look at this chart, you'll see the rapid rise in money market yields. That's correct, but you've got to understand, money market rates are determined by short-term U.S. Treasuries. Money market yields are quoted as a 7-day average yield because they change on a regular basis. Look at what happened the last time they were at 5%. This is 2007, 2008, the real estate and banking crisis. They peaked a little over 5%. Right now we're a little over 5%. But look at 2009. By 2 years later, they have dropped from 5% to 0.16. That's not 1.6%, that's 0.16. And if you see, as you look along the bottom of that chart, they've stayed low basically for the last 10 years. The rates you see now, as the Fed lowers rates, may very well disappear just as quickly. You cannot count on those rates as sustainable rates. All right, here's some key takeaways that you need to understand. First of all, we may be very close to the end of this interest rate cycle. Second, historically, if you buy bonds near the end of a rate hike, it results in stronger returns than waiting. And number three, over the past 4 cycles, waiting to allocate after the final rate rise lowered your returns over the subsequent 1 and 3 year periods. If you're an income investor, here is the key. Current conditions may provide some very favorable forward times. Now is the time to take some action. So, our commitment to you, we're dedicated to providing you with the best advice and strategies to navigate these challenging times. And what we do is we look back in history and bring history up to the current. When you watch the news, they talk about, for them, history is 5 o'clock that day. You've got to look down for the trends, and the trends are when rates are done rising, they start to fall, and they can fall very quickly. If you're an income investor, we believe this is an extremely opportune time to move into the income market. So call us. Our team is always here to assist you. And don't hesitate to discuss your individual situation. By the way, here's a couple other topics we talk about. Estate planning, how to protect your children from their inheritance. A very interesting presentation. Taxes and retirement. We've got to put together taxes and retirement. It's an interesting change when you go into retirement. You go into the distribution phase, and you've been in the accumulation phase. They're very different. Navigating Social Security, you have one choice, one time to make the right choice. It can be costly if you don't. And how to use your IRA very safely. So that's really the conclusion. Give us a call. And I want you to remember always, we're here looking out for you.